Hello traders, welcome back to our channel Investor Forex. Today's lesson is on the most widely used indicator called moving average. We also call it as simple moving average, or in short form you can even call it MA or SMA. So what exactly is this moving average? It does have a formula, but we won't be discussing about it as we don't want to stretch this video that long. But we will give you a summary which is easy to understand. You don't really have to by heart the formula. So moving average is the average of the moving prices. For example, here is the day 1. Its price was 1800, and on the second day it was 1802. Third day it was 1801. So we have total of 7 days. The average of this 7 days
that's our
was
average price from the
1801.10.
last 7 days.
It is called moving average because the price moves. So if we take the average price of each of these 7 days, and we'll get the moving average of that total of 7 days, so that span of time from the first day till the 7th. Each of these price are the closing price of the 7 days. So below we get the moving average of that time span of 7 days. New moving averages form from the next 7 days or the time span and after the current one, and one after the another. So it's not very complicated, it's quite simple. For example, let's go to the indicators and we will select moving average. Let's change the color from here in the inputs. Now the number 9 under the length is the number of days. So here we have moving average of 9 days. This red line is the moving average of the 9 days, similar to the example that we have shown before. Whatever time span you choose, its moving average will form along these candles. As you can see here, the formation of moving average along 9 days candles. Let's start this. We'll go to daily time frame. I'll change the length to 200. So whenever you see the price is above the moving average, then the price is bullish. And if the prices are below this moving average, then the price is bearish. So if this is our moving average, and if the prices happen to move above this, that means the price is bullish. Price is bullish. And if the price happen to move below the moving average, then the price is bearish. As you can see here, the price is bullish. It's because it is above the moving average. And over here, the price is bearish because it's below the moving average. Let's check in the smaller time frame now. Now the price at this point was bullish, and now the price is below moving average, so it's bearish. Let's go to 1 hour. Here we find that the price is bearish because it's moving below the moving average. Here also in the 2 hours chart, price is moving below the moving average, so it's bearish. On this side, the price is above the moving average, so the price is bullish. So by now you know how to find out if the price is bearish or bullish. But the question is how to trade using this indicator. Let's look at this area now. So whenever there is a breakout at the moving average like this one, price is intersecting the moving average at this point. And after the next candle, this candle right over here, will break the high of the previous intersecting candle. You see that? It means we can enter a trade. Enter position just after the breakout, and when there is a rejection, they run into loss. But we shouldn't enter the trade. It would be better if we enter the trade when the next candle after the intersecting candle breaks the high of the intersecting candle. And only after that we would enter the trade. And our stop loss would be the low of the intersecting candle. At this point, we will enter the trade as it broke the high of the intersecting candle, and there would be our profits. If you look at this bear candle now, there was a breakout but was followed by rejection, so no breakout. Even the bull candle next to it seemed to break out but was followed by rejection. We could enter a trade there as the next candle broke the high of this one. That's our stop loss. We can enter a trade here as we can easily book our profit. Their stop loss being here. If you want high risk rewards, we can even book profits still there, up. Let's look for more entries elsewhere. Let's look over here. The price is moving below the moving average, so it's bearish as you can see. Now, this area, here there was a breakout. There's an intersecting candle, but since the next candle didn't break its long, we won't enter any trade. So if the next candle to the intersecting candle doesn't break the high or low of the intersecting candle, then we won't enter any trade. Next, here the price bounced back from there, and here it tried to break out, and the next candle to the intersecting candle broke its low. These two candles here. Here is the intersecting candle. Here's the next candle that broke its low. And here's the opportunity to go short. Here's our stop loss, which will be the high of the intersecting candle. So if we are buying, then the stop loss will be at the low of the intersected candle. And if we go short, stop loss will be at the high of the intersected candle. So whenever there's a price breakout, And if the next candle breaks either the high or the low of that intersected candle, the breakout candle, and then only we can enter a trade. And high and low of that breakout candle or the intersected candle will be our stop loss. If we go short, then its high will be our stop loss, and if we go long, its low will be our stop loss. The risk return is totally up to the individual traders. So that's how we find our entries using moving averages. So now let's go to 4 hours chart. Here's the price is bullish. Let's look at here. There was a breakout. And the next candle, broke the low of the breakout candle. And we enter a trade just after it broke its low. But now as you can notice that the point to set the stop loss is too high. Here it is, it's too high. So for that we will go to smaller time frame. 2 hours, but still the stop loss is too high. That's not a good risk reward. So we will go to 1 hour time frame and see if there is any breakout. Here it is. Here's a breakout. We can see better as in what's happening in detail as we go to more smaller time frame. Over there was a breakout. Here at this point, this area. The next candle to the breakout candle broke its low. So now we can take an entry here. And over there, we can put our stop loss. And if we go to the more smaller time frame, over here, there is a breakout, and the next candle broke the low of that breakout candle. Here we can take an entry. Now we can book our profits. Now our stop loss will be at the high of that intersected candle here. There's our book profits. That's how we can use moving average indicator to enter profitable trades and find entries, watching out for breakouts. So that's all for now for today's lessons, and make sure you subscribe to our channel Investor Forex so that you don't miss any update. So see you at the next lesson. Have a great day.